So you remember last month, right? October 8th specifically, global markets came under intense pressure after Italy's Deputy Prime Minister Matteo Salvini attacked European Commissioner Jean-Claude Juncker, called him an enemy of Europe. The back-and-forth showdown coming to a head tomorrow. This is when Italy is required to submit a new budget that many think will look like the old budget already rejected by the EU. I think it's large European exposures. Why Goldman Sachs, these shares are getting hammered. It's down even more percentage-wise than Apple. The EU is in trouble. Italy is defiant. Back with me, Kevin Kelly, also joining us, President and CEO of International Assets Advisory, Ed Cofrancesco. Ed, let me start with you. Apple started, I think, this move to the downside, but, the carnage in the financials, particularly the downside on Goldman, I think we have to pay attention to and get to the bottom of.
Well, Charles, first of all, thank you very much, and I'd like to extend my thanks to all the servicemen and women around the country, as well as our veterans on this special day. But getting back to your question, sure, we should be concerned with what's going on in the global economy and the problems in the EU, and is there going to be an ongoing trade war with the United States and China? But at the end of the day, the market's off, what, 5%, 6% from our all-time high of 27,000 using the Dow indicator. I think there's been a lot of hyperbole. I'm glad to see there's caution in the market, but we had somebody earlier today on your network saying this is the most overvalued market in history. I guess he didn't live through the tech boom of 2000 or the real estate markets here in Florida and Arizona and Las Vegas 12 years ago. So I don't know.
And I hear your point, but, Kevin, back on, for instance, the financials, though, are down a lot more than just a few percentage points. In fact, they never really got out the gate this year. And, this circles back, Kevin, to the idea that, the Brexit isn't going well. You've got serious issues in Europe, and it's a cause for concern. The political upheaval there is a cause for concern.
Yeah, it's a big cause for concern. And you also have another headline which is impacting Goldman today, and that's their Malaysian fund that they helped finance. And so you have the prime minister over there coming back for several $1 billion. So that's another issue. And so when you look at the financials, you're seeing that they should have all the impetus to go higher, right? Their net interest margin should be going up because interest rates are going up. The economy is doing well. So what's really impacting them? And I think it is geopolitical concerns. I think you're also seeing a lot of gridlock. There may be inquiries from the House Financial Services Committee that may impact their sentiment going forward.
The reason this is important, if technology loses its ability to lead this market like it did before, it's 26% of the S&P. Your next largest sector are financials. Yep. They're 15%, and they have yet to provide any leadership. Ed, I love your calm exterior. We need that from time to time, and I don't have to be the one with the pom-poms today. But what turns this market around? When will the masses feel as comfortable as you feel right now?
Oh, I don't know if the masses are going to feel comfortable for a long time. I think Kevin just made some good points. The same type of geopolitical risk that we're talking about for the great financials, and I do mean the big financials. I think the mainstream financials will do fine, but the big ones, the Goldman Sachs, the J.P. Morgans, Morgan Stanleys, et cetera, of course are concerning. I think the people have seen a great bull market for this last 9.5 years, and now they're waiting to see, okay, is the market really going to fall apart like so many doom and gloom sayers have been predicting, or is the market going to finally, just rest a little bit and allow Main Street, which for most of these last 9.5 years was trailing the market. Main Street had 7 years, 8 years where it didn't do anything. It's only been the last 2 years that Main Street is finally starting to get back to work, and we're starting to have a great economy. And so maybe we need a little bit of cooling off on Wall Street. Maybe that's what we'll see. I'll tell you this, we're not worried at international assets of the market falling apart until such time as everybody tells us it can't. Then we start getting worried. We've seen that in the past. In the interim, we are advising our clients to be smart. Use trailing stops. Use protective puts.
Well, you're going to get stopped out of a lot of names then these days because, the volatility is such that, selling begets selling. And, then you throw in the algorithms and some of the other things that may not have anything to do with fundamentals, but certainly are dictating the market direction recently.
Yeah, one of the things that investors should take note today is that the fixed income markets are actually closed. So we're not getting an indication on the yields, right? We're seeing the dollar get stronger. Normally that would lead yields to go lower. And we see there's three things that are actually impacting stocks going forward for the outlook for next year, right? We have rising labor costs. We had rising energy costs, but now we've seen oil come down. And then we also had larger costs when it comes to labor, right? So labor is going up, and that's impacting the margin. So it's all based off of sentiment and next year's growth. And so we've had one of the pillars come down when it's come to energy. Now we have to see where the yields go as well as where labor goes.
Ed, you brought up the fact that Main Street just now getting some traction, and I agree with you, and this is why I'm concerned that the Fed starts to put roadblocks in. It would be a shame having, printed up $4 trillion to save Wall Street, but, putting up speed bumps just as the average worker out there seeing a pay hike. What's your thoughts on the Fed here?
Our thoughts at International Assets is the Fed has probably got 75 basis points that they still plan on raising rates. Will they be able to execute on the 75 basis points? I think Wednesday's economic numbers in terms of how much prices are going up will show us the way.
Right.
In the same token, if the market shows weakness, maybe we won't get to 75. Other people think we could get 100, 125. I think that the sweet spot is probably at 75. If we see the 75, I think Main Street will keep moving along and keep growing. If we see more than that, I think the Fed could wind up crushing.
75 would equal 325 hikes, one in December, 2 next year. I think that's palatable to everyone. We'll see if it happens. Kevin and Ed, thank you both very much.